Howdy, folks. It's Dr. Jeff Camarda. It is Monday, September 14th, and I've been holding the videos per all of your feedback and kind of just waiting till we had some important stuff. And I've got a couple items I'd like to review with you today. You no doubt have noticed increased market volatility over the past week and a half now, or just for the Labor Day holiday and continuing. And I'm kind of, I guess, I've got mixed feelings about sharing that just over the weekend and today in the Wall Street Journal. Both Barron's and the Wall Street Journal have officially declared, at least in some of their articles, the U.S. stock market to be in a bubble, which is something I wrote about actually for Forbes a couple of months ago in July. And what is a bubble, by the way? A lot of you folks probably are not familiar with the term. And I'll be doing a class on this and some tax matters as we get closer to the election, probably late this month, early or sometime in October. But a bubble basically is defined as market prices that have expanded all at a proportion to rational valuation. The South Seas bubble, which actually trapped Sir Isaac Newton, among others, the famous Dutch tulip bubble. These things occur with regularity, really, throughout history, where people just get a little wacky, and they think prices are going to go up forever. Bubbles tend to end very badly. Sudden collapses, evaluations as the bubble bursts. But that's what it is. It's a market where prices are just wacky high and completely or nearly completely without economic underpinnings or justification. And eventually the music stops. People wake up and realize, gee whiz, that Twinkie isn't worth $100,000. And they start selling and selling and selling and heading for the exits, and that just accelerates and prices plunge. So that's what a bubble is, officially named a bubble by Barron's over the weekend. I get it electronically now, but I printed this out to make a couple of points for you today. This is a graph, by the way, of you can't see it well enough, but just showing how tech stocks have become really very, very frothy valuation-wise. And they mentioned a couple tech darlings, Tesla and Zoom. Some of you out there, I know, in the Camarda community really have become enamored of Tesla. But some of the statistics are sobering. The Tesla, for instance, has gone up 344% this year, almost 4 times the money, and is trading at a price to earnings ratio based on estimated earnings for next year of 131 times. Now, what does that mean? It reminds me of Yahoo back in 1999 and some other NASDAQ wacky inflated stocks back then. So what a PE ratio of 131 means that if the company paid out every nickel of earnings, and for Tesla, these earnings are fleeting, right? It's by no means establish itself as a reliable producer of profits. But if it paid out every nickel of earnings, that means an investor would have their money back in 131 years. 131 years, PE of 131. And Zoom trading at a PE of 147, which has gone up almost 5 times this year. They also mentioned in the article that retail trading, those day traders, remember that term from back in the day, folks, sitting home and gambling with their money. Retail trading now accounts for 44% of the market total, which is really, really high. You'd think that they wouldn't have much of an impact these days with institutions, but it's kind of surprising. And they also point that another strange aspect of the current market, I quote from Barron's, which they call the existence of multiple bubbles. The one defined by the NASDAQ 100, these are tech stock, get most of the attention, but the run-up in shares of companies that have sought bankruptcy protection. Would you believe it? A bubble. People paying crazy prices for companies at death's door. It doesn't really make any sense. So we're concerned about bubbles, have been for a while, and there was another piece in the Wall Street Journal this morning I won't bore you with. Also from Barron's over the weekend, a piece entitled, again, I know you can't read that unless the light's just right, but inflation is popping up in the strangest places. So let's talk about why one of the reasons that's widely ascribed to the run up in stock prices. You know, where one of my dear friends and clients told me about, he saw a political cartoon or an image where, you know, the front is like a house, right? The front says stock market, it's all nice and painted, you know, great house, great curb appeal in perfect condition. Then there's a view from the backyard and it's on fire. There are rats crawling around. It's crumbling, you know. So the facade of the market doesn't really reflect the reality of the economic situation. Thanks, by the way. That was a great thought that you gave me, my friend. But one of the big reasons that the market looks so good is described because the Fed is just cranking out the money, overstimulating the economy, trying to keep us, you know, from falling off the cliff into Great Depression times. And because of this, they're just creating a lot of money, right? Many of us feel that this is going to produce inflation. You know, the old classic description was, you know, too many dollars chasing too few goods, or just a supply and demand. And if the supply of dollars is really great, you know, that they become less valuable, right? So inflation popping up in all strange places, according to Barron, and it seems to be kindling, and I think it's going to get a lot worse. But the core CPI rose, according to Barron's this weekend, at an annual rate of 5.1% since May of this year, the fastest rate for a 3-month period since March of 1991. What is that, 30 years ago? You know, we haven't really seen inflation in this country since the 70s and early 80s, but I think it's coming back. So some of you other old timers like me might want to remember what those times were like and the sorts of strategies that made sense in order to preserve some value to the dollars, the incredible shrinking dollars, which is what inflation does. And it's really, you know, the way the government measures inflation is somewhat arbitrary and maybe not very representative in this environment. One thing to think about, I asked Kim and you know, and some others, is that, you know, what do you pay for food these days? My understanding is that the price of food is going up pretty dramatically. What's the explanation for that? I mean, gasoline is cheap, fuel is cheap, transportation is cheap. You know, the trucks are rolling across the country. You know, farmers are, you know, certainly producing. So you got to wonder why. So just a warning flag here of what may be coming down the road. So some of the, you know, putting this together, you know, what are the risks to retirees in the years to come? Those of our clients, you know, most of you are there or planning for retirement. That's a prime function that we serve for you. And some of the things we're really concerned about and what we're trying to manage around. Because remember, bubble, it doesn't matter. Gee whiz, you know, the market went up, you know, this high, and my account's only here. But again, unless that value lasts, the bubble bursts and values go down into the basement, it doesn't really matter. Unless you cash in on it, it doesn't really matter. Unless you convert, you know, that notional value on a statement to, you know, to real family wealth, it doesn't matter. It's just, you know, it's just a high score in a game you eventually lost. So risk to retirees are preserving value against the days when the bubble, if we are in one, and I fervently believe, obviously, and have for months that we are, preserving that value so you're able to get through and realize your financial goals as effectively as possible. Guarding against inflation, which I think is going to be a real risk going forward, and structuring portfolios to give us a better probability of preserving purchasing power through inflationary times. And the worst, the most insidious one, a lot of folks I don't think still don't appreciate, is taxes. You know, the pressure in this country because of fiscal trajectories, before we even talk about the implosion of Social Security and Medicare, the trajectory for higher taxes later in the century was almost inevitable before COVID. And now, you know, having to pay for, you know, all this trillions and trillions in stimulation, and it's still not even close to being done yet before we're out of the woods. You know, there's only one place the government gets money from, and that's taxing your pocketbook, taking a piece of family wealth. Now, taxes, I think, are going to be fierce going forward. So our strategy, our course, to help guide you through this is not, I'm sorry about the glare on my face. I should have done a better job of the lighting before I pulled the trigger on the video. Please forgive me. But number one is what I call dancing on the bubble trading. Just because the market is hyperinflated and values can't be justified doesn't mean that we can't make money for you, try to make money for you through this period. That's something that the tactical trading team is working very hard on, and I'm very pleased, and they are, I think, with the results so far. I think you will be too, as you see some of that throughput onto your statements. And a second, but keeping a hair trigger, on the gun to get out, buy and hold for the long term. This is just not a normal environment. And while that has been our mantra for most of our history, this is a different time, and it calls for different tactics, which we're deploying on your behalf. The second thing is being very much on an inflationary or hyperinflationary stance, looking to structure portfolios that give us a better shot at preserving value through inflationary times, which we think are inevitable. And then most important, being awfully tax savvy. As you probably know, I studied taxes, have for decades, and I'm now getting an advanced degree from Georgetown Law School, a master's in tax law, basically. But looking for just more sophisticated, effective ways to work the tax code to preserve as much family wealth for you as we can. So that's pretty much the message I wanted to share. As always, if you have questions or concerns, feel free to email me directly, j@camarda.com. And I also wanted to mention we have a couple of classes coming up. Thank you all, by the way. We had a record number of students for the class on asset protection and risk control a week or two ago. And coming up, and I'm not sure exactly what the dates will be. These may not be a month apart for logistical reasons, but one is going to be on a bubble, how to identify a bubble. This is derived from a class basically I taught when I was in PhD school on bubbles, which I think you'll find very useful and informative. Share that with your friends that may not be aware of the straits that we think the market is in. And it's secondly on tax strategy and the sorts of taxes that we may see regardless of who wins in November. Though obviously, one winner will accelerate things if they can more than the other. But in any event, I think that higher taxes in this country are inevitable. And talking about some of the sorts of taxes that are developing, whether the part of tax strategies now for candidates or just kind of in the playbook that we'll see later on, and what you can begin to do to kind of structure your finances to control them. And that's pretty much it. Thank you so much for watching. As we push up on the quarter-hour mark, those of you who stayed with me, I thank you very much. I'll try to spare you another video this week unless the world changes such that it becomes required. So thank you so much. Talk to you soon. This is Dr. Jeff Camarda signing out. Hold it on. Good night.